Today is the last session of our series. The topic for the today's session is taxation impact on corporate restructuring assets and fairness assessment and appeals assets. The speaker for the entire series is CMA Dakshit Sokshi sir. I welcome our speaker CMA Dakshit Sokshi sir. Sir, over to you.
Thank you, Vinayak sir. Good afternoon, everyone. Today we are going to cover two topics. One is taxation impact of corporate restructuring, and my voice is audible?
Yes.
Hello.
Yes.
Okay, great. And another would be faceless assessment. So I said, Vinayak sir, with these two topics, our webinar series on income tax will come to an end today. And let me tell you, both the topics of today are very interesting topics. So first, we will start with the topic of taxation impact of corporate restructuring. So what is corporate restructuring? When we reorganized financial structure or legal structure or ownership structure or operational structure or any other structure of a company, it is called restructuring. And why do we restructuring? To make it more profitable, to make the organization better organized, or maybe the needs of the time compels us to go for the restructuring. So how the corporate restructuring is done? One of the structure is we modify the capital structure. Another could be we refocus on certain things. We refocus on certain products. We refocus on certain activity. We refocus on certain unit or certain undertaking. Another could be downsizings. We may be carrying out multiple activities. Some of the activities may be profitable, some of may have turned out to be non-profitable, or with the passage of time, it might have become outdated. So we downsize our operations. Then we go for merging. Merging will study in detail. Merging can happen with another company or two or more companies gets merged themselves, or we may demerge. We demerge some of our undertakings or some of our activities. Another could be we modify our operations, or we collaborate with someone for some manufacturing activity or some for particular product, or we venture into a joint venture, or we may divest our investment, or we may close down the operations partially. Why we go for restructuring? Why a corporate needs to go for restructuring? One of the important criteria for why the corporate structure, why the corporates are compelled to go for restructuring is the financial crisis. So whenever the financial crises are felt, the need of restructuring gets arisen to eliminate the financial crisis. With the passage of time, the competition would have increased, the level of competition would have changed. So to become globally competitive, the corporate restructuring exercise is undertaken. To enhance the organization's performance, the corporate restructuring exercise is undertaken, or to develop core competence, or to enhance competitiveness, or sometimes the management change the strategy, or to increase the market strength. So all these are the factors which makes the corporate organizations to go for the restructuring. How the restructuring exercise is being done? By amalgamation or merger, by demerger, by takeover of the company, by sale of certain assets or certain unit or certain undertaking, by reduction of capital or by way of buyback of shares, by venturing into joint venture, by going for strategic alliance with someone, or by change of structure like we convert our private company to LLP and vice versa, or we convert our private company to public limited company and vice versa. Broadly, the restructuring would fall under two major heads. One would be the financial restructuring and another would be the organizational restructuring. So whenever the restructuring takes place, certain important issues arises. And these all issues are very critical from the point of view of restructuring, because the success of restructuring depends on how these critical issues are taken care of. One of the important issues regarding income tax. So no restructuring will be successful if the income tax impact is not analyzed and neutrality of income tax is not achieved. Another could be GST issues. Whenever the assets is transferred, we need to see the implications of GST. There could be very legal issues. There could be social issues also. When we are divesting certain things or we are closing down certain operations, naturally social issues get addressed there. Another important aspect would be the valuations. When we go for the merger or when we go for the demerger, how valuation would be undertaken. Another could be funding issues, because whenever the merger takes place or when any kind of restructuring takes place, the need of funding would arise. So how the funding issues are resolved. Another issues could be like stamp duty, competitions, accounting issues. So whenever the restructuring is framed out, we need to understand all these issues in detail. First, we talk of Income Tax Act, then we need to see what are the regulatory approvals required. The income tax would affect three parties. One, the transferred company, another would be the transferee company, and the third one would be the shareholders. So one need to understand the impact of income tax in the hands of transferred company, transferee company, and the shareholders. Another important criteria would be the unit might have certain carry forward losses or on depreciation. So how the benefit of such carry forward of unabsorbed depreciation losses can be taken care of? If these losses, if the carry forward is not available, it might impact the income tax liability to a greater extent. And another important would be continuation of various benefits or reductions which an organization is already availing, and these are yet to be availed. As far as GST concerned, it could be regulatory approvals, GST on transfer of assets. This needs to be looked at. Whenever any corporate goes for restructuring or merger or amalgamation or demerger or buyback of shares, naturally Companies Act will play its role. Section 230 is very well known, speaks of scheme of arrangement. So we need to understand the provisions of sections 230 to 234 of the Companies Act. There are a lot of legal compliances as far as MC is concerned. We need to file various forms, various updates to ROC, and then any change, any scheme would need the approval from NCLT or ROC. Then stamp duty, as we know, is state-wise laws. So we need to understand the impact of state-wise stamp duty laws and the transfer regulations, the registration procedure for transfer of the assets in the name. Then if a company is a listed company, SEBI would play its role. We need to understand the SEBI regulations. We need to understand the stock exchange regulations. We need to understand the takeover code regulations. And wherever any foreign entity is involved, the FEMA would have its own play. Then we need to understand the RBI approvals. We need to understand the FDI implications. In today's topic, we are going to study the income tax impact of corporate restructuring. So first thing is the merger and amalgamation. Under the Income Tax Act, the section 2, which is the Definition Act, section 2 IB of Income Tax Act gives the definition of merger. It says that merger would be merger of two or more companies with another company. Like there are company A and B and it gets merged with another company. Then merger of two or more companies to form one company. Like there is a company A and B and they would get merged and they would form one another company. This speaks of section 2IB speaks of only of companies, applicable only to companies and not to LLP or firms. And for any merger to qualify under these sections, three conditions needs to be satisfied. First thing is all the properties of the transferor should get transferred to the transferee. So to make merger amalgamations, it's essential that all the properties and all the liabilities both of the transferor company is transferred to transferee company. If it's only certain assets which gets transferred, then it won't be called merger. Another thing is, important thing is from the shareholding pattern. 75% shareholder of the transferor company should become the shareholder of the transferee company. So these three are the basic fundamental conditions which needs to be satisfied. As we said, 75%, that is 3/4 of the shareholder of the transferor should become shareholder of the transferee company. So when we say that 75% of the transferor shareholders will become considered. So here it's not necessary that transferee company should also have 75%. If the transferee company has a larger shareholder base, then it might be possible that even if by becoming 75% of the transferee company, the shareholder of the transferee company may not have a 75% shareholder of the transferor company. It might have lesser. So this percentage is to be viewed only from the angle of the transferor company. Another criteria is the shares which are allotted to of the transferee company should not be subject to any lock-in period. Another criteria is transferee company should be an Indian company. And if acquisition of all the properties of one company by another company is not a merger, like if all the properties gets transferred by one company to another, but there is no change in the shareholding pattern, then it will not fall under the definition of merger. So for merger, the transfer of shareholding of 75% is one of the important criteria. Now, normally, as we said earlier, the merger or amalgamation takes place to eliminate the financial crisis. So normally it happens that a loss-making company would get merged with the profit-making company. But sometimes the reverse thing happens. Like normally it is normally a big fish will eat small fish. But sometimes it happens that a profit-making company is merged to the loss-making company. Like a smaller fish and larger fish. So smaller fish will take the larger fish. So this is called the reverse merger. This is very important from the purview of the taxation. So as per the taxation requirement, the strategy of merger or reverse merger takes place. So whenever a loss-making company is merged with the profit-making company, it is called the reverse merger. Now let's understand the income tax impact. As we said earlier, one of the important criteria is carry forward of loss and carry forward of unabsorbed depreciation. Then tax neutrality for company and for shareholder both. For company means both the companies, transferor company and also the transferee company, and in the hands of the shareholder. Another thing would be amortization of expenses. Certain expenses would be incurred in the process of amalgamation or merger. So how the amortization takes place. And another would be the effective date of the merger. So now we know that in any of the amalgamation schemes, two dates are very important. One is called the appointed date and another is called the effective date. So we as a professional, we know the difference between appointed and effective date. Appointed date refers to the date on which the merger or transfer takes place, wherein the property, assets or liabilities of transferred company shall which is the transferee company. This will be the date which will be considered that on from this particular date, the transfer of assets and liabilities would take place. Whereas effective date denotes where the merger is completed and the companies merged are notified by the ROC. So there would be certain legal procedures which would take time, and once the ROC, the forms are filed with the ROC and approval is notified in the ROC, that will be called the effective date. So from income tax point of view, appointed date makes appointed date is very crucial. Now let's understand taxability in the hands of shareholder. As we know the section 47, so whenever any transfer of capital asset takes place, it is required, it is subject to the capital gain. But section 47 says that certain transfer of capital asset would not be regarded as a transfer. So one such section is section 47(7), which speaks of taxability in the hands of shareholder in the scheme of amalgamation. So section reads that when any transfer by a shareholder in a scheme of amalgamation of a capital asset being shares or securities held by him in the amalgamated company, if the transfer is made in consideration of the allotment to him of any share or shares in the amalgamated company, except where the shareholder itself is the amalgamated company and the amalgamated company is an Indian company. So whenever the transfer takes place by a shareholder of the shares held by him of the transferred company, which is as per the scheme of amalgamation, then there would be tax neutrality in the hands of a shareholder and it will not be subject to any capital gain tax. Same way, we need to understand the taxability in the hands of transferred company. So any transfer in a scheme of amalgamation, if the transferee company is an Indian company, then there will be tax neutrality in the hands of transferred company. Now, if shares are held in an Indian company by a foreign transferred company to a foreign transferee company. Now, when shares held in an Indian company are transferred by a foreign transferred company to a foreign transferee company, both companies, foreign transferred company and transferee company, both are the foreign company and they are holding the shares in the Indian company. Then the requirement is that minimum 25% of shareholders of foreign transferred company should become shareholders of foreign transferee company. And such transfer should not attract capital gain in the country where the transfer company is registered. So these two conditions would be required when the transfer company and transferee company both are a foreign company and they are holding the shares in an Indian company which gets transferred. Another thing is whenever the amalgamation of a banking company with banking institution takes place, which is sanctioned by the central government under the Banking Regulation Act, then also there will not be any impact of capital gain. Another would be amalgamation of a foreign company which derives its value substantially from shares of an Indian company. Here also the same conditions of 25% would be applicable. So as we said about the amortization of amalgamation expenses. So whenever the amalgamation takes place, huge amount of expenditure gets incurred. So how the expenditure would be eligible for deductions? So wherever any Indian company incurs any expenditure for the purpose of amalgamation, so then 1/5 of such expenses are allowed as deduction every year for a period of 5 years. So once the amalgamation is done, in the previous year in which the amalgamation is made effective, the transferee company will be eligible to claim 1/5 deduction of the expenses which are incurred exclusively for the amalgamation for a period of 5 years. So this is section 35DD. Same way, section 3617 speaks of treatment of bad debts. Because it happens that in the case of merger or amalgamation, the date of transferred company gets transferred to the transferee company. It may happen that at a later stage, such debt may become bad debt. Now, this is the debt which is not originated from the transferee company, but which has come to the transferee company from the transferor company. So, in such cases also, deduction would be allowed in the hands of the transferee company. Section 72A, that is about carry forward of losses and absorb depreciation. Now, this is applicable only to manufacturing companies, to IT companies, to shipping industries, telecom industries, hotels, banks, and minings. It's not applicable to trading company or hospitals or real estate company or stock broking company or to service company. So whenever the merger of a trading company or a hospital or stock broking company or any service company takes place, they will not be in a position to take the benefit of carry forward of losses or carry forward of unabsorbed depreciation. So for taking the benefit of carry forward of loss and absorbed depreciation, section 72A, 2A and 2B. 2A speaks of the transferred company, 2B speaks about the transferee company. So there are certain stipulations which needs to be satisfied by both these companies, transferred company and transferee company. Only if these conditions are satisfied, then only the transferee company will be able to take the benefit of carry forward of losses and carry forward of forms of depreciation. So what are those conditions? As far as the transferred company is concerned, it should be in the business in which loss occurred or the depreciation has remained unabsorbed for 3 or more years. So transferred company should be in this business for 3 or more years in which such loss was incurred or the depreciation has remained unabsorbed. For transferee company, the criteria is that at least 75% value of fixed assets of transferred company should be held for a minimum of 5 years. So once the assets are transferred to the transferee company, the transferee company should continue holding at least 75% value of the fixed assets for a period of 5 years. If before a period of 5 years it sells off the fixed assets, then he will lose the benefit of carry forward. Another thing is you should continue the business of transferred company for a minimum period of 5 years. He should fulfill such conditions as may be prescribed to ensure the revival of business of transferred company, to ensure that the amalgamation is for genuine business purpose. How this can be achieved? So for this, the transferee company shall achieve at least 50% of installed capacity before the end of 4 years, and it will maintain it till the end of 5 years. Plus, transferee company need to produce a certificate from a chartered accountant, that is a prescribed form number 62, which speaks about the achievement of the production level. So to justify that the transferee company has achieved at least 50% of the installed capacity of productions, he will need to produce a certificate from a CA in this regard. So transferred company is very simple. It should be in a business for 3 or more years, and transferee company should use those assets at least for a minimum period of 5 years. He should continue the business of transferred company for a minimum period of 5 years, and he should achieve the production level at least up to 50% of the installed capacity. Once these conditions are satisfied, the transferee company will be allowed to carry forward the losses for a fresh period of 8 years. Now, this is very important. As we know, the losses can be carried forward for a maximum period of 8 years. Now, suppose the transferred company has already carried forward the losses of say 5 years and only 3 years were pending. But once the merger takes place, the transferee company will get a fresh period of 8 years. So from the date of transfer, the, the zero date will start and transferee company will be able to carry forward such accumulated loss for a period of 8 years. Another important thing is to carry forward the loss. Only loss under the income from business or profession is allowed if loss is under the head income from house property or capital gain, that will get lapsed. So in the sense that if there is a loss which was under the head of income from house property or capital gain, neither the transferred company nor the transferee company will be allowed to take the benefit of carry forward. So these loss will get lapsed permanently. Only the loss under the head income from business and house property will be carried forward. And as far as unabsorbed depreciation is concerned, it can be carried forward indefinitely. Now, suppose there are certain stipulations, conditions which we saw that this needs to be satisfied to carry forward the losses and unabsorbed depreciation. But suppose if these conditions are not fulfilled after say 2 years or 3 years, the business of the transferred company stopped or the assets are transferred of a value of more than 75%, then what happens? Then the set-off of loss or allowance of depreciation made in any previous year in the hands of transferee company shall be deemed to be the income of the transferee company in the year in which such conditions are not satisfied. So whatever the loss, whatever the benefit of set-off of loss or the benefit of unabsorbed depreciation has been claimed by the transferee company, that will be lapsed and that will be deemed to be the income of the transferee company in the year in which such conditions are not satisfied. So it will not happen that in the past, in the previous years, the assessment would be redone. No, it will be taxed as the income of the current year in which such lapse has happened. Other important points are Section 242A of the Income Tax Act. Section 2 is the definition act. Like it says what would be the short term and what would be the long term. So for calculation of whether the asset is held for a short term period or for a long term period, the period of the holding held by the shareholders in the amalgamated company will also be considered. So someone is holding the shares in the amalgamated company of 5 years and now the shares are merged into the amalgamated company. Then the period of holding which was held by him for the previous company will also be counted for calculating the long-term period of say 12 months or 36 months, whatever be. Another section is section 49(1). Same way, the cost of acquisition of the said asset to the amalgamated company shall be the cost for which the amalgamated company acquired it. Section 49(2). The cost of acquisition of the shares for the shareholders in the amalgamated company shall be the cost of acquisition of the shares in the amalgamated company. So whatever be the cost which was there in the amalgamated company, that would be treated as the cost as far as amalgamated company is concerned. And if the assets were acquired before 1st April 2001, then at the option of the SSC, they can take the fair market value of 1st April 2001, sorry, 2022 is a mistake, 1st April 2001 as also the cost. So the SSC has got the option to substitute the cost fair market value as on 1st April 2001 if the assets were acquired before 2001. Section 115JAA, the credit of MAT under Section 1J of transferred company can be carried forward and set off by the transferee company. And section 43(1), when the entire cost of asset is allowed as a reduction as a 35D in the hands of transferred company, then its value will be nil. Whenever it happens that in the transferred company had already claimed entire cost of the asset as a reduction as under section 35D. So once he had already claimed the total amount of the assets by way of reductions, so its value would be considered as nil in the hands of the transferee company. Like double benefit, double deduction cannot be allowed. So as deduction is already claimed in full by the transferee company, by the transferred company, for transferee company, the value would be 0. Now, as we said, reverse merger. Reverse merger is merger of a profit-making company with a loss-making company, like a healthy company merging itself with a sick company. So in such cases, as the losses belongs to the loss-making company and the existence of loss-making companies continues. So all losses after depreciation normally gets carried forward as a normal carry forward. So with this, let's speak about the demerger. Section 2, 19AA defines the demerge. As per the definition of the Income Tax Act, demerged company means the company whose undertaking is transferred pursuant to a demerger to a resulting company. So it's very simple definition. It says that when undertaking is transferred pursuant to a demerger to a resulting company, it will be called a demerger. Now, what is resulting company? Section 241A says that company to which the undertaking of the demerged company is transferred in a demerger and the resulting company in consideration of such transfer of undertaking issues shares to the shareholders of the demerged company. So resulting company is the company to which the undertaking of demerged company is transferred and resulting company would be issuing shares to the shareholders of the demerged company. Between merger and demerger takes place when assets of two or more companies get vested in one company, which may or may not be one of the two companies. Just a moment. And demerger is when some part or undertaking of one company is transferred which operates completely separate from the original company. So this is a basic difference from of merger and to demerger. Merger is when assets of two or more companies get vested in one company. Now this new company may or may not be one of the original two companies. And demerger, it's very essential that some part or some undertaking of one company is transferred to another company. Another company will operate completely separate from the original company. If certain assets are only transferred, then it won't be fall under the demerger. To be effective under the demerger, the definition of demerger, it's essential that at least some part or some undertaking of one company is transferred. We'll study this in detail in the next few slides. So what happens in the demerger? In demerger, all properties of transfer company undertaking becomes properties of the resulting company. So under the demerger, the properties of transfer undertaking will become company. Is in same way, liabilities of transfer undertaking will become liabilities of the company. So all and the liabilities, the properties of the resulting company. Now, thing is, fees or liabilities at revaluation of assets has taken place, such revaluation would be ignored, and the transfer would shareholders holding 3/4 or more in value of shares in the demerged company become shareholders in the resulting company. Now, the same conditions was there in the merger, like 75% of shareholders in the demerged company should become shareholders in the resulting company. As we say, resulting is a new company in which the demerged company takes place. Discharge of issue of shares to the shareholder of demerged company on proportionate basis. Transfer undertaking should be on a going concern basis. So these are the main conditions which needs to be satisfied for demerger. And just like merger and amalgamation, which was applicable only to companies and not to firms and LLPs, the demerger is also applicable only in the case of companies. As we said, evaluation of the properties and liabilities will be ignored. Shares will be allotted to the shareholders on a proportionate basis, and shares allotted to the shareholders of the demerged company should not be subject to any lock-in period. So these four conditions are crucial. No lock-in period that was there in the merger and amalgamation also. And as one division is taking apart from the whole department would proportionate basis. Now, as we said, demerger, any undertaking or any assets or liabilities are sold off, or any combination of individual assets or liabilities which it not be considered as a merger. And in such case, the benefit of taxation of demerger would not be available. So undertaking does not include when sale of individual assets or liabilities takes place, or any combination of such assets which does not constitute a business activity. So for demerger, undertaking means that should be a separate business activity, and any particular part of an undertaking or a unit or any division which can be considered a particular business activity. If individual assets or liabilities, if that does not fall under the definition of particular business activity, then it will not be called an sale of an undertaking or demerger of an undertaking. So there is a very known judgment of Delhi High Court in the matter of Rama Textile Limited, which says that in a demerger, transfer of all common assets and or liabilities relatable to the undertaking being demerged is not required so long as the assets and liabilities transferred by themselves constitutes a running business, and the business can be carried on uninterruptedly with such assets and liabilities alone. So to ensure that the undertaking has been transferred as a going concern or not, while sanctioning a scheme of arrangement, the court can examine whether essential and integral assets like plant, machinery, and manpower, without which it would not be able to run as an independent unit, had been transferred to the resulting company. So this is very important criteria. So when the question of specific assets or specific liabilities and not the transfer of an entire undertaking takes place, one needs to study whether this particular such block of assets constitute a separate business activity or not, and whether the resulting company will be able to carry on the business uninterruptedly with the possession of such assets and liabilities. If it is not, then it will not be called, not fall under the definition of demerger. So for to demerger to be effective, it is very essential that the assets are transferred should be an independent assets and it should be in a position to qualify as an independent business unit. So along with the assets, naturally liabilities would also be get transferred to the resulting company. So like specific assets, that would be specific liabilities which would get transferred to the resulting company. Liability arisen out of the specific activity, if liabilities is arisen out of specific activity for which the assets are transferred, so those corresponding liabilities would also get transferred. And if there are general liabilities which are not specific to any particular activity, so it will get transferred in the proportion to the assets transfer. So when there is a specific liability will get transferred. When there is no specific liability, is a general liability, then it will get transferred in the proportion in which the assets are transferred. So what are the tax implications? If the transfer falls under the definition of demerger, if the criteria which we just discussed are satisfied, then there will be tax neutrality as far as an Indian company is concerned. So there would be no capital gain on transfer of capital assets where resulting company is an Indian company. Further, as far as the shareholders is also concerned, there would be no capital gain on issuance of shares by the resulting company to the shareholders of the demerged company. Cost of shares in resulting company would consider proportionate to the net book value. Carry forward of losses and depreciation will be allowed. No dividend implications would arise on issue of shares by resulting company. When the resulting company issues shares, will not be considered as a deemed dividend, and resulting company would be chargeable to tax as a successor in the business. So these are all the tax implications if once the conditions of the demerger is satisfied. So section 47 speaks of the tax neutrality. So demerger if resulting company should be an Indian company. Now as we studied, as we just saw in the amalgamation about the foreign company, here also when the demerged company and resulting company both are a foreign company and shares are held by them in Indian company, then minimum 25% of the foreign demerged company should become the shareholders of foreign resulting company, and such transfer should not attract capital gain in the country of transfer. So if both these conditions are satisfied, then it will be tax neutrality for the demerged company. And same thing would be same qualification, same criteria when transfer by demerger of a foreign demerged company which derives its value substantially from shares of Indian company to a foreign resulting company. So here also if 25% of foreign shareholders of foreign demerged company becomes shareholders of foreign resulting company, then it will be a tax neutral transaction. One absorb depreciation and loss. Now there would be a depreciation. Now it might happen that demerger takes place on a not at the end of the year but on a in between the year. So the allocation between the demerged company and the resulting company needs to be done. So such division would be done, such apportionment would be done in the ratio of number of days. So depreciation in respect of assets transferred to the apportioned company to be apportioned in the ratio of number of days used by demerged company and resulting company. So based on the number of days which are being used, the depreciation would be amortized. Return on value of the block of assets in the transfer order company shall be reduced by the return on value of the assets transferred in the demerged company. Now transferred company would be holding certain block of assets, and out of certain block of assets, some portion is transferred to the resulting company. So return on value of block of assets will get reduced by such value. Same way, return on value of the depreciable assets in the case of resulting company will be return on value as per the income tax records at the time of demerger. And loan borrowings not specifically relatable to transfer undertaking will be apportioned in the ratio of assets transferred to the total value of the assets. So when there is any liability like loan borrowings, which is not a specific to particular undertaking which is getting transferred, but if it is general, then it will be apportioned in the ratio of whatever is the asset transfer to the total value of the assets. If 50% of the asset is transferred to the demerged company, to the resulting company, then the loan borrowing will also be considered at 50% level. Losses and unabsorbed depreciation of the demerged company shall be carried forward. Where such loss or unabsorbed depreciation is directly relatable to the undertaking transferred to the resulting company, then it will be allowed to be carried forward and set off in the hands of the resulting company. Now, the loss, unabsorbed loss and depreciation can be in two parts. Such loss and unabsorbed depreciation, something can be directly relatable to the undertaking which is transferred. So, in such a case, it will be carried forward and set off in the hands of the resulting company. And where such loss and unabsorbed depreciation is not directly relatable to the undertaking, then it needs to be apportioned between the demerged company and resulting company in the same proportion in which the assets from the taking have been retained by the demerged company and transferred to resulting company. And it will be allowed to be carried forward and set off in the hands of demerged company or the resulting company as the case may be. So when there is a loss or unabsorbed depreciation which cannot be directly relatable, cannot be directly allocated, then it needs to be apportioned. The apportion will be the considering the value of the assets which is transferred to the demerged company. So in that proportion, the loss and unabsorbed depreciation will also get apportioned between the resulting company and the demerged company. So how the apportionment between demerged and resulting company will take place? So first, we need to calculate the depreciation as if there was no amalgamation, there was no merger or there was no merger. So once computed, the depreciation amount will be apportioned between the demerged company and resulting company in the ratio of number of days for which the assets were used by them. Same thing is about the amortization of demerger expenses. Just we treat section 35DD in the case of amalgamation. In case of demerger also, it might happen that the resulting company would have incurred certain expenses. So these expenses would be allowed in the hands of the resulting company 1/5 every year. So 20% of the expenses spread over a period of 5 years, 20% each would be allowed as a reduction in the hands of the resulting company. Same thing would be about the treatment of bad debts. As we see section 36(1)(7). So when the debt of demerged company, which is transferred to the resulting company, turns bad, so it will also be allowed as a reduction in the hands of the resulting company. So it's very important to understand that whenever the demerger takes place, the definition of demerger should get satisfied. Because if it turned out that no, this is not a demerger, this is merely a transfer of certain assets only, so then such benefit which are available exclusively under the scheme of demerger would not be available. Now let's talk about the slump sale. So what is a slump sale? Slump sale is transfer of one or more undertaking for a lump sum consideration without values being assigned to the individual assets and liabilities in such transfer. So when the transfer of certain assets and certain liabilities takes place, but there is no valuation attached to the individual assets or individual liabilities, and one certain amount is calculated, then it will be fall under definition of lump sum. Such sale would consider as a lump sum sale. So here also the term undertaking is very important. The term undertaking includes part of the undertaking, but whatever undertaking is transferred, it must constitute as a business unit to be carried on without any interruption. Now, as we see the same definition in the case of demerger, if there are certain loose assets and loose liabilities which does not constitute a business unit, then such demerger will not be considered as a demerger for the income tax purpose. Same way, whenever the slump sale takes place, it undertaking or part of undertaking must constitute as a business unit. The consideration for such transfer may be discharged by the transferee company in any mode. Now here, consideration is paid to the transferred company and not its shareholders. Slump sale provisions do not provide tax treatment for the purchaser. Hence, the purchaser may split actual consideration paid for the going concern and treat the assets liabilities accordingly as if it is acquired in the normal course of business. Because slump sale is like sale by a company of its certain assets or part of undertaking. So whenever the consideration takes place, consideration would be from the transferee company to the transferor company. And as there is no provision for tax treatment in the hands of the purchaser, purchaser will treat it as a going concern and the assets and liabilities as if he has acquired the assets and liabilities in the normal course of business. And the cost of acquisition of undertaking can be apportioned on the assets forming part of undertaking at values as determined by independent valuers. Now, the purchaser has acquired certain assets, but the value of each of the assets has not been identified because it is for a lump sum consideration. But the purchaser would be required to assign certain value to such assets. So for this, he need to obtain a valuer report. And as per the valuation report, he needs to account the individual assets in his books of accounts because it, such value would be a value forever. And whenever the transfer takes place or even for the depreciation purpose, such value would be the base for calculating the depreciation, for calculating the profit on sale of the assets or capital gain, whatever. So it's very important that whenever the lump sum sale takes place, the purchaser obtains a valuation report to justify the value mentioned by him in books of accounts. And cost show apportioned by the transferee company will be considered for depreciation in the section 32 as regards the depreciable assets. So in future, to ensure that in future no dispute takes place, it's always advisable to obtain the valuation report. So as per section 50B, transfer company is liable to short-term or long-term capital gain. If holding period of 36 months, it will fall under long-term. If it is lesser, then it will be fall under short-term. Now, how the capital gain would be calculated? So capital gain would be whatever the consideration he has received less net worth of the undertaking. So suppose he has sold out one undertaking, so he needs to calculate what is the net worth. Difference between the value of consideration received by him less net worth would be a capital gain. And so if the net worth of the taking is negative, then the entire sale consideration becomes capital gain. So if net worth is negative, then net worth would be considered as zero. So full value of consideration less zero. So entire value of consideration which he has received would be subject to capital gain. Now how to calculate the net worth? So net worth would be aggregate value of written down value of block of assets and book value of other assets of the undertaking less value of liabilities of the undertaking. So for calculation of the net worth, as far as block of assets is concerned, the written down value will be considered, and for other assets and for other liabilities, whatever is the value appearing in the books of accounts would be considered. If there is any revaluation, then such revaluation would be ignored. Further, benefit of indexation is also not available in calculating such gains. Loss and absorbed depreciation naturally remains with the transferor company because this is a sale of certain assets only and not a sale of a particular undertaking. So loss and absorbed depreciation will continue with the transferor company. Now, how to calculate? Now, there are multiple assets which are transferred, and undertaking consists of multiple assets. So, how to consider, how to bifurcate such gain under the long term and short term? So, the criteria is very simple. If the undertaking is held for more than 36 months, then it would be a long term capital gain. And if the undertaking is held for less than 36 months, then it would be a short term. So instead of considering the purchase date of individual assets and liabilities, that undertaking, which is the period of the undertaking, would only be considered. Now let's see the buyback of shares. Buyback under the Companies Act can be carried out in accordance with Section 68 or through a scheme of arrangement approved by NCLT. Now, Section 68 provides that a company can purchase its own shares. Now, these conditions are very important. To buy back the shares, he can purchase the shares only out of free reserves or out of securities premium account or proceeds of issue of any shares or specified securities. So if no buyback shall be made out of proceeds of an earlier issue of the same kind or out of same kind of other specified securities. So for buyback, the company needs to have free reserves or securities premium account. So what are the criteria for buyback? So buyback should be authorized by articles of association. Special resolution is required to be passed. However, if the buyback is 10% or less of total paid up capital free reserves, then buyback can be authorized by the board by way of a board resolution, and special resolution is not required. Now, quantum of buyback. Now, buyback shall be 25% or less of the total paid up capital and free reserves of the company. Aggregate of secured and unsecured debts owned by the company after buyback should not be more than twice the paid up capital and its free reserves. Now, this is very important criteria. Like aggregate of secured and unsecured debts after buyback should not be more than twice the paid up capital and its free reserves. So once the buyback is happened, we need to study what is the paid up capital and free reserves, and the secured and unsecured debts of the company should not be more than twice of such paid up capital and free reserves unless the central government approves such a higher ratio. All the shares or other specified securities for buyback should be fully paid up. So if it's a partly paid up shares, then it cannot go for a buyback. So before buyback, even if there are any partly paid up shares, it needs to be made fully paid up. So if the shares are listed, then the procedures, the regulations pertaining to stock exchange and SEBI regulations need to be complied with. And if it is unlisted shares, then buyback cannot be done within a period of 1 year from the date of closure of the preceding offer of buyback. So once the buyback is announced, minimum period of 1 year should lapse for an unlisted shares and securities to go for another buyback. So between two buyback, minimum period of 1 year is required. So as per section 1034A, the tax on buyback of shares is levied at the level of the company, and consequential income arising in the hands of shareholder is exempt from tax. So under section 115QA, any domestic company which buy back its shares, its own shares, is liable to pay additional income tax, like it is, which is 20% plus 12% surcharge and plus cess of 4%. So in one compliance, it is known as buyback tax. So how buyback tax would be calculated? It would be distributed income consideration paid by the company on account of buyback plus amount which was received by the company for issue of such shares. So difference of this would be considered as a distributed income, and on this tax would be payable. Now let's see conversion of company into LLP. So and as we know, LLP is a hybrid form of an organization which combines the benefit of a traditional partnership firm and a company. This is a unique amalgam of flexibility of ownership, management, and control, just like a partnership firm, along with the benefits enjoyed by corporates like separate legal incorporated entity, limited liability, and ability to raise equity funding from overseas. So this form of LLP has become more popular than a private company now because of its blend of benefits, right? It remains the flexibility of a partnership firm along with the benefits of a corporate entity, and in particular that of limited liability. So the LLP Act permits conversion of private company into LLP and unlisted public company into LLP. That's section 56 and section 57, which permits the LLP Act, which permits the private company and unlisted public company, they can convert themselves into LLP. However, if the companies are into banking, finance, or insurance, if companies have secured loans or securities, if companies have external commercial borrowings, if companies have FDI, foreign direct investment under approval route, and companies engage in business governed by certain specific sectors which regulations do not recognize LLPs, so in such cases, the companies cannot convert itself into LLP. So how the conversion takes place? First is transfer of all assets and liabilities. All the assets and liabilities of the company immediately before conversion become the assets and liabilities of LLP. All shareholders to become partners in LLP. So all the shareholders of the company immediately before conversion becomes partner of LLP, and their capital contribution and profit sharing ratio in the LLP should be in the same proportion as their shareholding in the company as on the date of conversion. So the shareholders have to maintain the same shareholding pattern in the partnership firm, in the LLP. They cannot change the ratio of their profit sharing ratios or their holding ratios. Consideration to the shareholders of the company does not receive any considerable benefit other than by way of share in profit and capital contribution in LLP. So on conversion, the shareholders of the company should not get any other thing other than the share in the profit and capital contribution in the LLP. Profit sharing ratio of shareholders should not be less than 50% at a time during a period of 5 years from the date of conversion. Now this is very important. Total sales turnover gross receipts in the business of the company should not exceed 60 lakhs in any of the 3 previous years preceding the previous year in which such conversion takes place, and total value of assets should not exceed 5 crores in any of the 3 previous years preceding the previous year in which the conversion takes place, and no amount to be paid to any partner out of accumulated profit of the company as appearing on the conversion date for a period of 3 years from the date of conversion. So if there is an accrued profit, it cannot be distributed to the partners for a period of 3 years. So if conversion of company into LLP takes place and if conditions are violated, then transfer of capital asset is to be done at the market rate and accordingly capital gain is to be calculated. Transfer of other assets like stock in trade, current assets is also to be transferred at market value and the applicable taxes is to be paid. Now what will be the impact on the shareholders? The shares in the hands of the shareholders of a private company will be converted as the capital of the LLP. The shareholders has to pay tax on the capital gain arising from such transfer, and the value of capital is the consideration for the transfer of shares. The cost of shares is the amount paid by such shareholder at the time of purchase of shares. So on this, the capital gain will be required to be paid.
Hello. Hello.
Yes, sir.
I think that sister's voice is not coming on.
Now he joined.
Hello. Sorry, my connection got dropped.
Okay. Continue,
Yeah.
sir.
Yes. So as we had to cover two topics today, I've gone little fast. So with this, we have come to an end to the presentation of business restructuring. And now we will go with the presentation on faceless assessment. Faceless assessment. The Honorable Prime Minister Narendra Modi launched Transparent Taxation 2020. Income tax assessment through electronic mode was made mandatory. The move was made to reduce interaction between income tax officers and SSC, and as a result of which the government feels corruption would be reduced to a greater extent. Show faceless assessment, faceless appeal, and tax charter. So what is faceless assessment? The faceless assessment scheme is one of the biggest direct tax reforms in India, which is based on key principles of efficiency, transparency, and accountability. With this, the department is bringing about a paradigm shift in building the future with technology by pioneering and economic systems of assessment appeals founded on data and artificial intelligence. Faceless assessment is going to transfer income tax administration. What are the features? Data-driven selection of cases for scrutiny using data analytics and artificial intelligence. So the cases would be selected for scrutiny using the techniques of data analytics and artificial intelligence. This would abolish territorial jurisdiction. Return of taxpayer belonging to one city would be scrutinized anonymously by AOs based in the other city. So the assessing officer would not be knowing the taxpayer, neither the taxpayer would be knowing who is the assessing officer. Automated random allocation of cases to assessment units through computer. So there will not be any subjectiveness in selection or allocation of the cases. And centralized issue of notices using unique document certificate number through electronic modes. So there will be no human interface, no need to visit the income tax office. All the responses would be submitted electronically, and there would be team-based assessment and team-based review. So the judgment of one single person would vanish, and it would be a team-based approach. So this will result into expeditious disposal of cases, ease of compliance for taxpayers, transparency and efficiency, functional specialization, and improvement in quality of assessments. Functional specialization for specific parts of assessment by different specialized units. Now government can create specialized units, like somebody who is special in the steel industry would assess the cases of steel industry. Somebody in the power would assess the cases of the power industry. Only a single point of faceless contact between the taxpayer and the department. Adverse draft assessment order shall be provided to taxpayer for response before finalization of the assessment order. So once there is any adverse assessment order, a draft assessment order would be sent to the taxpayer for his comment, and only after his comment, the final assessment order would be issued. Dynamic jurisdiction. Draft assessment order in one city, review in another city, and finalization in the third city. So nobody knows each other. And ease of tax compliance through uniformity in application of law. So these are the broad landmarks on which the income tax department is going to function. So what is the structure of income tax authority? NEAC, REAC, and under that assessment unit, verification unit, technical unit, and review unit. Now we'll just try to understand the structure. National E-Assessment Center is the only authority which will virtually connect with the SSC. National E-Assessment Center is at the top, and whoever has to connect with the income tax department, it would be National E-Assessment Center only. So only this National E-Assessment Center will send notice and it will receive response from the SSC. It will transfer documents to the required units and will facilitate conduct of proceedings in a centralized manner. So National E-Assessment Center would be the key point, key factor who would conduct all these transactions. All the communications among different units will also be routed through NEAC only. And Principal Chief Commissioner of Income Tax or Principal Director General of Income Tax will be the in charge of NEAC. So what would the NEAC would do? NEAC will specify format, mode, procedure, and processes after approval from the board. It will allocate e-verification under section 136 to verification units through automated allocation tool. It will send all notices and communications electronically. It will assign cases to assessment units through automated allocation system. So even there are multiple assessment units, the assessment units would also be selected randomly through automated allocation systems, and cases will be assigned without any subjectiveness. On a request for verification by an AU assessment unit, allocated case to verification units through automated allocation systems. So even the case to verification units would also will be through automated allocation systems. Provide technical inputs through technical units, including on issues such as legal, technical data analytics, forensic accounting, forensic information technology, valuation and audit. Inform Itself inform assessment unit if SSE fails to comply with a notice. It will select draft assessment order for review and allocate to review unit through automated allocation system. Where review unit suggests modification, it will allocate case to an AU other than the original AU through automated allocation system. So everything is automated and everything is going to be transparent. Like one assessment unit has passed an order. It is signed to the review unit. Review unit suggests certain modifications. Then such review will not go to the original assessment unit, but it will go to a different allotment assessment unit. It will provide opportunity to taxpayer in case any order prejudicial to SSC before finalizing assessment order. As they say, draft assessment order would be issued. It will finalize the assessment orders. It will transfer all electronic records to jurisdictional AO for post-assessment work, and it will transfer cases to jurisdictional AO after approval from the board. So NESC is the center point which will coordinate with the different units like assessment unit, verification units, technical units, review unit. It will also correlate with the SSEs, and it will function as a centralized body, and it would be a faceless. Then we have got regional EAC, regional e-assessment centers with 30 headquarters across 20 cities, and each ADC consists of different units and it reports to again NEAC. So these are the regional e-assessment centers. Each regional centers would have principal commissioner of income tax and additional CITs and DCITs and ITOs. Then comes the assessment unit. This is the unit. This is like our assessing officer. It will perform the functions of making assessment, like determine liability or refund according to Act. So assessment unit is just like our assessing officer who used to do functions of our assessment. It will identify points and issues for determination of a tax liability or refund. It will seek information or clarification on issues and analysis material or submission by the assessing. It will seek assistance from the verification unit and the technical unit. It will prepare draft assessment order. Verification unit will perform the function of verification, right? It will conduct inquiries. It will examine books of accounts. It will examine witness. It will order cross verifications. It will record statements through video conferencing, etc. So there is to complete two steps. Earlier, this task was being done by the assessing officer only. Like he used to examine our books of accounts. He used to call us for verification, cross verification. He used to record our statements. Now there are two units. One assessment units, another is verification units, and another is a technical unit. Technical unit will provide the technical assistance to the assessing office, to the assessing unit for legal, accounting, forensic, information technology, valuation, transfer pricing, data analytics, etc. So and then comes the review unit. It will review the draft assessment order. It will check whether relevant and material evidence has been brought on record. So before any assessment order is issued, a review takes place. It will first analyze whether assessment order is imperfect from all angles or not, whether relevant and material evidence has been brought on record, whether relevant points of fact and law have been incorporated in the draft order or not, wherever any law is required or any case laws is required to be mentioned in support of additions or in support of any disallowance of expenses, whether those are properly narrated or not, whether issues on which addition or allowance should be made have been discussed in the draft assessment order or not, so that at a later stage in the appeal, the department can strengthen their stand, where whether the applicable judicial decisions have been considered and dealt with in the draft order or not. It will also check arithmetical correctness of modifications proposed, if any, and any other functions which required the review would be done by the review unit. So these are the four pillars: assessment unit, verification unit, technical unit, and review unit. Each has got its own independent functions, but all the functions are very interrelated, and it leads to, after review, after the functions of these four units, the assessment order gets generated. So what is the difference? This vast difference between present assessment systems and the proposed faceless assessment systems. Present assessment systems cases case selection is through a systems or manual, or whenever we receive certain input, certain tax evasion informations from some unknown persons. Whereas under the faceless, there is completely no discretion to any officer, no selection except through systems and alerts. Selection would be only using the artificial intelligence systems or data analytics tools. So no selection other than information based. So only the system will generate, artificial intelligence will work, the data analytics tools will work, and the case would be selected for the scrutiny. Under the present system, cases were permanently assigned to a territorial jurisdiction. Like if we are in Ahmedabad, our case will be handled by the IT office at Ahmedabad. If somebody is in Mumbai, this case will be handled by somebody having jurisdiction in Mumbai. Here, it's automated random allocation of case, dynamic divisions to any faceless team anywhere in the country. So if somebody is from Mumbai, his case might be handled by someone sitting in Bangalore, and the assessing officer would not also be knowing that his case is being handled from Bangalore. Earlier, in the present system, issue of notices were both manual and system. However, here there will be no discretion in the issue of system. It will be system generated notices triggered by alert. All notices will be with DIN. Notices will be issued electronically and centrally from the NESC in Delhi, and NESC would be only the single point of faceless contact between the taxpayer and the department. So they have established various units like assessment unit, verification unit, technical unit, review unit. None of such unit would have any interaction with the taxpayer. Only NESC would be the single point of faceless contact. Under the present system, during scrutiny proceedings, multiple physical meetings between the taxpayer and the officers takes place. We, as a tax practitioners, we know we were waiting long in the income tax department before the meeting takes place. So a lot of time was getting wasted in going to the department, sitting there before our turn comes, then wait for our 2 hours before our turn comes, and then number of multiple physical meetings. Here, no physical meeting with any officer, no officer to call the taxpayer to office. Earlier, we used to receive call from the income tax department also for some of our clients to come and appear, or to seeking certain more information, or seeking certain more explanations, certain more data. Now, no such call, no, now will not receive any such call. No more waiting outside the office. The identity officer will remain unknown forever. No human interface at any stage, and assessment also will be done in electronic mode. Earlier, there was wide discretion with officers, leads to subjective approach and varying interpretation. Here, no discretion with any individual officer. It will be team-based assessment. As we see, there are four pillars: assessment unit, verification unit, technical unit, review unit, and each will give their own inputs, and based on such input, assessment would take place. Draft in one city, review in another city, finalization in the third city. So draft assessment order will be prepared in one city. Its review would be done by the review unit in who would be sitting in another city, and the finalization would be done in the third city. So objective is very just fair and just order. So earlier there were a lot of staff, officers, so many staff were involved in the income tax department. Now the faceless assessment will reduce the staff also. So as we can see, the National Faceless Assessment Center is at the key point. Everything would be routed through National Faceless Assessment Center only. Like assessment unit, verification unit, technical unit, review unit, SSC, everybody would be interacting with the one face, and that is a faceless, National Faceless Assessment Center. We'll study this in detail. So hearing also would take place through video conferencing, no personal hearing. If SOCOS notice is served, SSC can request for hearing. So in charge REAC may approve request for hearing, and a hearing will be conducted exclusively through video conferencing only. So let's now try to understand the faceless assessment procedure. How the faceless assessment will work. Like we see in this chart, if we see the number 1, first is service of notice by the National E-Assessment Center to the SSC. Then SSC number 2 is the submit response. Then number 3 would be the case would be assigned to the assessment unit. Then assessment unit would request for information, request for verification. It would request for technical assistance. So assessment unit would demand information, verification, technical assistance, all to National will send the request to verification units, to technical units, to review unit, and verification unit would submit that response to any AAC, and in turn any AAC will pass it on to assessment unit. So this is how all things would be independent and all things would be integrated at one place, that is National E-Assessment Center. So how this will work? First, any AAC shall serve notice to the SSC, and SSC would be asked to reply within the stipulated time. And then NEAC will assign case to specific assessment unit in any one regional assessment unit through automated allocation systems. So once the case is received by the assessment unit, the assessment unit would start the assessment. So for that, he may need certain informations. So whatever information is required, he will not ask directly to the SSC. He will ask to any AC for obtaining information, documents, or evidence from the SSC, conducting inquiry or verification by the verification unit, seeking technical assistance from the technical unit. So if certain verification is required to be undertaken, as AU will not ask directly to the verification unit. AU will put a request to NEAC, and in turn, NEAC will send a request to verification unit. If assessing unit needs certain technical assistance, technical input, it will request to NEAC only, and in turn, NEAC will send its request to technical unit. So NEAC shall issue notice to the SSC and assign request to verification unit and technical unit. After receiving documents from SSC and reports from VU and TU, NESC shall transfer the same to the assessing unit. Hello. And if SSC fails to comply with notice, then SSC shall notice under section 144 as to why assessment should not be completed to the best of its judgment. SSE shall within the time frame will file reply to NESE only. And if SSE fails to respond, then draft assessment order will be issued. NESE shall examine draft assessment order as per the risk management strategy and automation exception tool, where it may decide to finalize assessment order, provide opportunity to SSE if modification is proposed, and assign draft assessment order to review unit for the review. So the review unit, you will conduct review of draft assessment order, and it may decide to concur with the draft assessment order and intimate to NESE, or it may suggest modifications and send its suggestions to NESE. So once the assessment order goes to review unit would have naturally two choice. Either it would accept or it would suggest certain modifications. Whatever be, change or no change, both the things will be intimated to NESE only. So what NESE will do? So upon receiving concurrence of review unit, it will finalize the draft assessment order. And if review unit has suggested certain modifications, it will assign case to another assessment unit other than AU which has made the draft assessment order. AU, now the new AU will come into picture. The new assessment unit shall, after considering the modifications suggested by the review unit, send the final draft to NESE. And after that, NESE will finalize the assessment order. So where so-cause notice has been served to SSE, and he shall furnish reply within the time frame. So NESE shall, if suppose no response is received, then he will finalize the assessment order as per the draft assessment order. So if there is any adverse things, then show-cause notice will be issued to the SSE and to file the reply within certain time. If response is received, if the SSE sends the response to such show-cause notice, it will send response to the assessment unit, and assessment unit will make draft assessment order and will send it to NESE. So NESE, after receiving the revised assessment order, if modification is not prejudicial to the SSE, finalize assessment order. And if modification is prejudicial to the interest of the SSE, so he will provide opportunity of being heard. So NESE shall deal with the response with the same procedure, and AU will make draft assessment order and so on. So this entire things on paper looks very transparent and ekdam effortless and clear. So NESE, after completion of assessment, transfer all the electronic records to the assessing officer having jurisdiction over the said case. So if there is suppose penalty is to be imposed or recovery of demand, then it will be transferred to the respective assessing officer. So everything is centralized to the NESE only. Assessment unit, verification unit, technical unit, review unit. All the units have its own role to play, and everything becomes seamless and integrated without any human interference. So how to know if our case is picked up for faceless assessment? We'll get the notice under section 143.2. It should be digitally signed by NESE officer. It will be received in our registered account along with SMS and email. Now, no more physical issuance of notice. The notice will be signed in our email account, and whatever is the phone registered will get an SMS also. So what is expected from the taxpayer? See, this is all this is like system generated thing. Everything is automated. There is no human interference. So the SSE, the taxpayer also needs to be little alert. He should file reply electronically through e-filing account only. He should ensure that correct email ID is mentioned in the ITR, as all communication will be through email only. Now this is very important. Sometimes it happens that client would have multiple email ID, and He might not be seeing or checking the emails regularly. So in such case, it might happen that email has been issued, but he is not able to see it, and he missed the deadline. So once the email is signed, it will be deemed that the notice is served to the assessing. Sometimes we may use, as a consultant gives its own email ID, which is though not advisable, but it is required that assessee or taxpayer gives proper correct email ID and checks email ID very regularly. Sometimes if email ID is not used regularly, he may forget the email ID, he may forget the password. So this, at least care should be maintained to remember the email ID and password. One thing is also that now there is no need to file physical copies of the reply. Once the reply has been filed electronically, it is gone. It is gone forever, and there is no need to submit physical copies. No physical appearance is also required. And suppose even if we demand that give us an opportunity of personal hearing, such hearing would be takes place through video conferencing only. So this is a very seamless exercise where each each units, assessment unit, verification unit, technical unit, and review unit had got its own role to play. And their role is very independent, very specific. Though it is interrelated, all the units function independently. So earlier, the thing which was being done by one assessing officer is now being done by different units independently, and all units are also not interlinked. All units are linked only through REAC or NEAC, and all the things from NEAC will pass on to these units, and these units will interact only with REAC or NEAC. So there is no interconnection or interlinkage with these different units also. So this makes the system very transparent, very robust, and very effective. Now comes the faceless appeal. Trust, transparency, and tax. Faceless appeal scheme from 25th September. This is what Ministry of Finance says. Ministry of Finance says the features are appeals to be randomly allotted to any officer in the country. The identity of officers deciding appeal will remain unknown. No need to visit the officer or office. The appellate decision will be team-based and will be reviewed. So no decision would be an individual decision. So the subjectiveness of one individual will get lapsed, will no longer there. However, there are certain exceptions to such faceless appeal. Cases relating to serious fraud, major tax evasion, sensitive and such matters, international tax matters, Black Money Act, Benami Property Act would not be the faceless. So now let's understand the faceless appeal. This was introduced in September 2020. Like faceless scheme is pari materia with faceless assessment procedures. And order passed by CIT appeal will be subjected to review either by National Faceless Appeal Center or by another CIT appeal. So not applicable for businesses in this steps are prescribed for condonation of delay, allowing additions of penalty and addition of evidence. So what is National Faceless Appeal Center? National Faceless Appeal Center shall serve as the nodal agency and interactions between any AC or the assessing officer, the appellant, or any other person and the appeal units. The NFSC will serve as the central authority and will be granted the jurisdiction to facilitate the e-appeal proceedings and decide the appeal. So accordingly, any contacts between the appellant or any AC assessing officer in the EU shall be conducted only through NFAC. Same way there will be regional faceless. It will enable the conduct of e-appeal proceedings and will have the authority to rule on the appeal in accordance with the scheme's regulations. New Delhi, Mumbai, Chennai, and Kolkata make up the 4 regional centers. So what is the new scheme of faceless appeal? First thing is compulsory to allow a personal hearing if requested. Earlier, for granting request for a personal hearing, if SSE has requested for a personal hearing, whether to grant the personal hearing or not, the word may was used. So it was a subjective, he may or may not grant. However, this has been replaced, substituted by the word must in the new policy. So it would be obligatory for the Commissioner Appeal to grant a personal hearing if taxpayer requested during e-proceedings. Role of regional faceless appeal center is removed. So under the regional faceless appeals were facilitated to conduct the e-appeal proceedings. Under new scheme, the board has removed regional faceless center. Now an appeal is directly assigned to commissioner appeals of a specific appeal unit. Now the National Faceless Appeal Center we shall assign the appeal directly to Commissioner Appeals of the appeal unit. No need to send a recommendation to NFS to initiate penalty proceedings. So under the erstwhile scheme, for any non-compliance with any notice, direction or order, the appeal unit was required to send a recommendation to the NFSC to initiate penalty proceedings. Now the new scheme has removed the requirement to send such a recommendation. The Commissioner Appeal has been authorized to send a notice to the appellant through NFAC to initiate any penalty proceedings. So new scheme of faceless appeal penalty proceedings to be initiated by the same Commissioner Appeals. So in the erstwhile appeal scheme, NFAC assigns the initiation of penalty proceedings to a specific appeal unit in any one RFAC through an automated allocation system. This appeal unit may or may not be the same unit that completed the appeal proceedings. However, in the new appeal scheme, the same Commissioner Appeals who has completed the appeal proceedings is authorized to conduct penalty proceedings. Orders passed by the Commissioner Appeals to be digitally signed. So under the new faceless appeal schemes, all orders, appeal orders, penalty orders, and rectification orders must be digitally signed by the Commissioner Appeal prior to being transmitted to the National Faceless Appeal Center. So in the old model, appeal were not permitted to sign orders electronically. So now everything would be electronically. So these are the major changes of the faceless appeal. This is a very known cartoon about the faceless raid. So are you sure this is a faceless income tax raid? So with this, we are coming to an end of faceless assessment and faceless appeal also. So if anybody has got any questions, the forum is open for question answers. Anybody else got any question? The forum is open. We have completed our discussion on fiscalist assessment, fiscalist appeals, and also on taxation on corporate restructuring. If anybody has got any question on any of these two topics, please raise the question. Hello.
Hello. Anybody has any question? Mm, It seems that everybody is now go through with income tax. So now I concluding this session and the series of income tax. WRC is very much thankful to CMA Dakshish Choksi sir and CMA Amit Sahni sir for providing us the in-depth knowledge regarding income tax. I am also thankful to the participants who participate in the series during this series. I am also thankful to the WRC admin who have uh, arranged this seminar and uh, webinar and all these admin tasks. So once again, I thank you all of you for participating and have a good day and goodbye. Thank you very much.